A Movement Mortgage.
Movement Mortgage.
I'm a senior loan officer.
Perfect.
Also known as a lender. We have many names.
Okay, so how long have you been in this role, first of all?
I have been in lending since 2006 and originating as a loan officer since 2013.
Okay, so you were in this business back in 2008.
Yes.
What was that like?
Yeah, interesting. I was fresh out of high school when I started in the lending business. And so every morning coming in during that crash and hearing the different banks that were taking over and what was really happening was my education of subprime lending. So the company that I was working for at the time closed down early 2008, and then I got back into the business in 2010 and worked for that lending company for over 7 years. And that's where I got the majority of all my experience and where I got all my licensing completed as I continued through school and getting my financial degree.
And things have changed a lot since then, and you're the expert. So, you know, back then, I think the problem was basically people weren't in fixed rates, right? Was that the big reason why people got in such big trouble? So right now, whatever mortgage rate that you get, if you find the perfect home, right, and you get your loan, you know that your mortgage isn't going to go crazy up and down except for like basically just for taxes, right?
Correct. Yeah. Your mortgage is fixed rate. You still have the option to get an adjustable rate mortgage. They are not popular these days. The loans that were done prior to the mortgage credit crisis, most of those banks have been closed down or no longer operating.
Yeah.
And what was your question?
Well, just basically like right now, so like I think a lot of people right now, we're talking New Year's goals, right? 2025 rolls around, it's a new year. A lot of people start thinking about, okay, what do I want to do this year? And I know there are a lot of people out there who either want to sell their home or they're looking to buy their first home, whatever it might be. And so I think people are keeping an eye on mortgage rates. And
yes, and mortgage rates, I think the reason why those home ownership goals were not met in 2023 and 2024 is because of the fear of interest rates and waiting for them to drop. And mortgage interest rates, they're not going anywhere. They're staying pretty stable, just below 7%. And values in equity and real estate has always historically and is expected to continue to rise. So probably expecting 3 to 5% in the next year. And I think it's important if your goal is to purchase a home is to write down that goal and start developing your team and meet with a reputable lender and connect with a real estate agent and putting together a game plan and start taking those baby steps.
Yeah, okay. And like then that's kind of why I was asking you about the fixed rate thing. So it's like if you have that plan in place, you know, say you get a 6%, you can know that if things drop, you could refinance, but it's not going to jump up on you.
Absolutely, yes. Yeah, the taxes and insurance will adjust very slightly, but your fixed rate is going to remain your principal and interest payment. That will not change.
Okay. Yeah.
Yeah, and the adjustable rates are still available, but they're not popular right now. But we can look at all those options that would be available to you so you can educate yourself and have the knowledge and confidence moving forward and meeting that 2025 goal.
So what are some of the advantages and disadvantages to someone, say maybe they have a 30-year and they decide, hey, rates in 5 years down the line, maybe now they're down to 4 or 5% or something like that, who knows, and they want to refinance. Is that something that you would recommend?
Absolutely. We'll look at break-even points and look at comparisons depending on the individual and what their future income looks like. If you're reaching retirement, are you ready to refinance into a lower term at a higher payment? Sure, you get a cut and a better interest rate, but when you're comparing the payment differences, that's why it's important to really sit down and look at those different loan comparisons and knowing what all rate options are available to you, what those terms are, what the return on investment and break-even points are. And a good team will be able to help through all that.
Something I see a lot of times, sometimes I just look on Zillow for fun, right? Just as kind of fun to dream, see what's out there. And I'll see houses that are for sale and it'll say something like you can kind of like take over the loan from the seller. But I don't really know what that means. I would assume it's because they have a great interest rate and
it's an assumable loan.
Yeah.
So
how does that work though? Is that risky?
No, it's definitely not a risk to look at if that is available to you and go through that option. And an assumable loan is really going to determine and be determined by the current servicer of that seller's loan. And if they have a $200,000 loan balance and you want to purchase the home for $500,000, you can assume up to $200,000 at their current interest rate, and then you could get with the lender to get the remaining balance that you need to be able to purchase.
I see.
At that going market interest rate.
So you have like two different payments going, but one of them might be at a lower rate.
Yes.
Okay, that makes sense. That's interesting. Do you feel like, I don't know if you can speak on this, but I mean, do you feel like right now is a good time to buy, especially in our area?
I think it's important to get your foot in the door and start building equity.
Yeah.
Those who have been waiting for interest rates to drop are now possibly paying more for a home because of the rise in values.
Right.
And as we see an increase in demand and more buyers out there, we're going to have more competition really driving up those values. And is it really a better deal when, like you mentioned, you could be refinancing at a lower interest rate perhaps?
How do you do, what do you think about like a 15-year versus a 30-year? Is there, if you can make a 15-year work, I mean, are you going to save a ton of money in the long run?
I do a lot of those comparisons with buyers. Back in the day, we used to see a bigger difference in interest rate between a lower term, and we can look at those payment differences. I think doing a 30-year and having that minimum obligation much lower and more comfortable, but making that higher payment when you can towards your principal reduction and still paying it off sooner without restricting yourself to a larger payment. So when times do get more difficult or something happens that's unexpected, you have an easier route to making a payment.
That's been kind of my tactic. But I always kind of go back and forth between should I be putting, maybe I could put a few $100 into principal every month extra, or should I increase my 401k contribution if I feel like it's one of those months where I have a little extra money? What do you think? Do you have thoughts on that?
I think that's a beautiful reason why you should develop and build that team and have a financial advisor along with your lender and your realtor to really know what those options are and understand prior to identifying property. I think it's a big misconception that we'll wait until we find property before we pull credit, and having the ability to really work with you to put together that game plan and with the soft credit pull and not even necessarily have to have a ding on your credit and still be able to put you in that prime position to make sure that you earn that best interest rate possible and know if your financial advisor sees the same routes as a lender and realtor.
Yeah, that's interesting. Now that you brought it up, the credit check and how that could impact your credit score. I mean, how big of a deal is that if you are thinking about buying a home but you're not sure, but like a lot of people might hesitate just because they don't want to say, oh, maybe I'm not ready for another 6 months. How do you make that decision?
Well, having that ability now to do a soft credit pull, there is no ding whatsoever.
Okay.
So to go through that initial step of the application and knowing what to expect is so important. And when you actually get a hard inquiry on your credit, it's not dropping your score. And once you have multiple inquiries or you're also applying for credit elsewhere, that's when you might see it drop a couple points.
I wonder if there's anything like any talk in the legislation or anything about like changing that practice. It's kind of bizarre, isn't it, that you would be penalized just for, hey, wanting to make a purchase and having somebody look into that for you. I wonder why that looks bad.
I think if you have the ability to borrow and show that you can make payments, it's not necessarily a bad thing.
Yeah.
But if you're just seeing where you can get credit, or if you're applying for credit cards and
That
autos
makes
and a
sense.
mortgage just to see.
Yeah.
Maybe that's more of
could be
the
why, yeah.
restriction
I don't know.
comes in. I don't know.
It's interesting. Yeah, who knows? Somebody knows. But yeah. Is there anything I didn't ask you about for people who are just, they're really thinking about it, especially, well, like, here's an example. Like for me, we have a house that's probably bigger than it needs to be because our kids are getting older, right? But we like our interest rate. So we'd like to sell and we'd like to downsize. I mean, is it a good time to sell right now?
It is. I think if you're considering it, definitely be looking at what those options are and putting together that game plan now. And also maybe if you need to get your property up to par or there's some work that needs to be done, and as a homeowner of many years, this could be a great time to tap into that equity and get the work done and then turn around and sell, but also comparing what work needs to be done, how much you're going to invest into that work, and make sure that your return on investment is what you're expecting.
Yeah.
Because you might not get as much value out of just adding to the home.
Your New Year's resolution might be like, okay, I'm going to sell my house or I'm going to buy a home, and you're thinking, all right, January 5th or something, but there is a lot that goes into it. So some planning may be the first thing you do for the beginning of the month.
Yeah, and maybe the plan for 2025 is save and get an idea with your team that you developed this year of what that is that you need to save to reach those home ownership goals for 2026.
Now, when somebody comes to you, they probably already have a realtor. They probably already have like a property that they're looking at. But do you work with other local companies if somebody were to come to you kind of a little bit prematurely? Do you have other companies that you can refer people to if they need a realtor or whatever it might be?
Absolutely, 100%. And if that is credit repair, we've got the credit repair team to be able to expedite to reach those goals. Or if it's a financial advisor because you're not sure where to invest or how because you have multiple properties, so we can all work together to make sure that we're reaching those goals.
Okay, is there anything I didn't ask you about that you think people should keep in mind? We talked about a lot.
I know. I think we covered.
Okay, cool, perfect.